We're just talking about the State of the Union, Barty. From where you sit, where's the asymmetric risk tomorrow night?
I'm not sure the market's going to pay a huge amount of attention to the State of the Union. I mean, it's probably going to be more politically oriented. I mean, I guess if you're worried about a market impact, does he ramp up any of the trade rhetoric in the speech? That would be the one thing I think that would concern markets. I mean, otherwise, I think to be honest, we're more focused on the fundamentals at the moment, and probably equity markets are a bit more worried about bond yields going through 2.7% than they are about the State of the Union address.
Well, fair point, and we'll get to the equity market in a second. So let's pivot off from what you're saying about bond yields. So 2.7 for the 10-year. How much higher can we go in yields, and what's the reverberation effect?
Well, our fixed income strategies have had a target of 285 for the end of the first quarter, so we think there is a bit more to go. And I think it's all about the speed. As long as it's gradual, as we've seen so far this year, it doesn't really derail the equity markets. But the further it goes, and particularly the faster it goes, the more risk that there is that at some point it becomes an uncomfortable level. And I think the key is, do the bond markets, we've got the Fed this week, do they start to anticipate that the Fed is going to have to go faster? It's still the case that the bond markets are not fully pricing the dot plot for the next 2 years. If the Fed gives a hint, actually, it's at least 3 hikes this year. Some people out there are saying, potentially it's 4. That's the kind of thing that I think might start to get markets concerned. Yeah,
Chad and I were just talking about that earlier, how that could start to really re-rate the market. What's your explanation, though, for the recent sell-off in the bond market? Is it ECB driven? Is it inflation? What is it?
Look, I mean, I think this was 2018 was always going to be the year where the central banks, one by one, had to start to withdraw their extraordinary measures. I mean, the Fed, is tapering its balance sheet, raising rates. Now we've got both the ECB and the BOJ, in effect, saying to the markets that we're going to have to start to exit. The ECB, we know, is going to do QE till September. It's probably going to fade it out this year. The market's attention is already going to when are they going to do the first rate hike. For the Bank of Japan, the fact that it's been tapering some of its purchases has got the markets talking about, are they going to shift yield curve control? And you saw the reaction to Kuroda's comments at Davos last week. So it's always going to be more difficult this year for fixed income markets, because the central banks are starting to take away some of the liquidity that supported those markets over the last few years.